When we're looking at putting our money in a position to work for us, there are 6 main things we can look at investing in: high interest savings, or HIS, government investment certificates, or GICs, bonds, stocks, mutual funds, and exchange traded funds, or ETFs. We know that when we have money sitting in our checking or regular savings account, we basically earn nothing. But banks and institutions usually have a higher interest savings option. It might be called something else and may require account minimums to qualify, but in return, our money can earn a higher interest rate. The rate typically fluctuates depending on where the Bank of Canada lending rate is. So similarly to stock market returns, it's tough to have a blanket statement as to whether or not an investment rate is good. It's relative to where things are. Although we earn a smaller return, the benefit of using high interest savings accounts is that our money isn't exposed to market risk, and we can easily calculate how much we should have in it at a specific time in the future. Because of this, high interest savings take the first place on our chart, expecting them to have the least amount of growth, but the least amount of volatility. GICs are similar to high interest savings in that they don't expose our funds to market risk, but they typically require you to lock them in for a set period of time. Since you are promising to leave your funds in place, you are rewarded with higher returns on your investments. Redeemable or not locked in GICs typically have an interest rate somewhere in between high interest savings and locked in or non-redeemable GICs. Depending on your goal's timeline, a locked in GIC might be appropriate, but you don't want to risk the funds being locked in when you need them. So you have to weigh the pros and cons and if the additional return justifies it. GICs fall around the same volatility as high interest savings, but slightly higher growth on our chart. Bonds represent an IOU from a company. You can think of it as you're borrowing a company money, and in return, they promise to pay you interest. It's the flip of us going to the bank to take out a loan. Because of this, bonds are seen as less risky than stocks, and appropriately provide a lower return. As we've seen in previous chapters, bonds still experience volatility, good years and bad years, but it's a lot more muted. The extremes in either direction don't go as far, and there are much more good years than bad. Someone could invest in a single bond through a brokerage account, similar to how you could buy a share of a company. Bonds move up on our chart in both expected growth and expected volatility, and stocks represent the peak of our options in both expected growth and expected volatility. It's the idea of risk and reward. The more risk or volatility, the more reward or growth we should expect, at least when done properly. Stocks represent a small piece of ownership in a company, and as an owner, you're entitled to receive a portion of the success the company has. That's why companies appreciate in value, or pay out dividends. It literally pays to invest in good companies, and can cost you if you don't. Instead of deciding which individual stocks and bonds to invest in, mutual funds are baskets of stocks and bonds that come in all shapes and sizes. Believe it or not, but there's actually more mutual funds than individual stocks. The options might be overwhelming, but there's something for every type of investor. Mutual funds can make problems like diversification easy, but one downside is they are typically actively managed. And as we've already seen in this course, the majority of people and companies trying to beat the market actually underperform it. ETFs are similar to mutual funds, but they are mostly passive, meaning that instead of trying to beat the market, they try to match it as closely as possible. Because there's no active manager involved, ETFs typically have very low fees, resulting in better returns. On our chart, mutual funds and ETFs share a lot of the same space, but since ETFs have lower fees, we can reasonably expect them to have higher returns. If everything else is equal, if your mutual fund has a 2% fee, you need a 2% gain in a year just to break even, whereas if the ETF equivalent has a 0.2% fee, your hill to start is much lower. Both mutual funds and ETFs can make investing a lot simpler, allowing us to focus on what matters most. But not all funds are created equal. So it's important to make sure that however we invest, it's aligned with our goals, time horizon, and risk tolerance. A high interest savings, or GIC, is a terrible way to accumulate a retirement fund over decades and decades, but it's likely the best way to save for short-term goals that are only a matter of months or a few years away. Bonds, stocks, mutual funds, and ETFs are ideal for medium and long-term goals, but could expose funds required for short-term goals to an unnecessary amount of risk. In each of these 6 investment options, there's going to be a lot of variety, with literally thousands of options for bonds, stocks, mutual funds, and ETFs. So it's important to choose the option that most fits with what you know and understand, and make sure that the option is optimized. If you like ETFs the most, you still want to invest in a great ETF, and not a terrible one. If you're not a Canadian, your country will likely have the exact same, or at least similar options for you. The names might change, but for the most part, they should just be different versions of each other. So if everything makes sense so far, I'll see you in the next lesson.